How to trade with Fibonacci retracement. Hi, my name is Vladimir Rybakov from Traders Academy Club, and in this video I would like to show you and introduce you to one of the most powerful methods I know and exist in the technical trading world, how to use the Fibonacci retracement. Plus, I would reveal some very important hacks to use this wonderful and very powerful trading technical tool. If you are new to the channel, I would like to invite you to subscribe and to join me in my free Telegram channel. To do so, just follow the link below in the description. So before we start, let's get a bit of introduction to the world of Fibonacci. Who is Fibonacci? Leonard Bonacci, or Leonardo of Pisa, later known as Fibonacci, was an Italian mathematician who, opposed to what many may think, is not the inventor of the Fibonacci sequence. He simply introduced it to the Western world in his book, Liber Attaci, Book of Calculation. Fibonacci sequence in a nutshell. The Fibonacci sequence is a series of numbers which describe in perfect proportions basically anything in the universe. That's pretty cool, right? The sequence derives by adding last two numbers together. 1 would be 2, 1 plus 1 would be 3, 2 plus 3 would be 5, 3 plus 5, 8, then 13, 21, 34, 55, 89, and so on. Mathematically, that is how it looks like. As you can see, okay, 1 plus 1, 2, 2 plus 1, the number before, 3, 3 plus 2, 5, 5 plus 3, 8, and so on. The ratios are called the golden ratios and are some of the numbers and levels we use in our trading. Fibonacci retracement in the technical world of trading. So you take any two following numbers like 21 and 34, you divide each another, right? 21 divided by 34, you get 0.617, all very close to 0.618, the very famous Fibonacci number. Okay, 21.55, the next following number to 34 would give you the 0.382. So basically, when you divide two of the following numbers, number and the next two, divide by the next two number in the sequence, you get 0.382, another Fibonacci number. Now you don't need to know these numbers really, but just want to show you how it works, because when you understand the logic, it makes much better sense. There are two main ways and tools that we use in trading that are at least the more popular and useful: Fibonacci retracement and expansions. In this video, I will present you a very powerful strategy to use Fibonacci retracement levels. So keep watching. And by the way, as I promised, I will reveal several tricks and hacks that no one did before. So watch carefully. So first of all, how to find swing high and low. Because many traders show you in the videos like you measure from the low to the top, and so far so good, right? But hold on, what is a high? What is a low? And the very important thing to say here is, in general, what was created by a move. Now, if you are looking, for example, at a movement from here to here, and you go to lower time frame, you would see here several waves combining this movement, right? Same from here to here. You go down, you would see that it was broken for several portions. When you are checking from here to here, you would see nothing, just one straight move. So that would not be an important separation of highs and lows. So highs and lows would be basically levels that represent real moves that you can see on the current time frame or verify on a lower time frame, one lower time frame, to make sure that's a real trend there. But I would like to give you some tricks, as I promised. Now, there are several indicators out there that many traders try to use to define tops and bottoms, or to define highs and lows, swing points. If it's fractals, if it's a very popular indicator zigzag, or many other different methods, nothing wrong with these methods. Of course, each has advantages, but I love the one that is pretty much static and doesn't leave our brain for imagination, wrong imagination. So the way I use that is I put two moving average. That could be any moving average, right? But they should be close enough and have like at least like 1:2 ratio in between them. So for example, 4 and 8 or 5 and 10, right? And of course, the bigger the numbers you would choose for your moving average, the bigger the trends that you would refer to. So in that case, I use 5 and 10, for example, and what I'm looking for is basically crosses. So I want you to use imagination, like that's one moving average, okay, that's another moving average, and every single time there was a cross, right, they crossed each other here. So when we, sorry, bad drawing, let me start here, that's what I mean, right? One, and then we have something like that, right? So when you have these crosses, each of them cross each other, that's where you would be able to find a real top that was top or bottom that was before the cross. Look here, cross, right? From down up, so that's a bottom. From up down, so that's a top, right? There was another cross here, so that's a top, that's a bottom, and all the way down, right? Bottom because there was a cross up, top because there was a cross down, right? We skip these two, as you can see, right? They're nothing. This becomes a bottom because there is a cross up. This becomes a top because there is a cross down. Again, nothing. That's just a noise. Okay. This would be bottom because it crosses up. That would be top because it crosses down. Bottom because it crosses up after that. Top because it crosses down. And this way you basically filter yourself the noisy conditions that you would not want to use as a high and a low. Okay, so this is of course just one way. I like it. Maybe it's helpful for you. Maybe it's something new you did know, maybe not. If it's new, I hope it helps. Now comes the next most important thing, which I want to show you how we choose our movements. So we want to choose the highs and lows. I showed you one method, but what I do want to see is from the moment I choose, from the trend I choose, okay, and I want to measure the Fibonacci on, what I want to do is I want to verify that this movement up was built by several pushes, so several mini waves, mini trends inside it. So I can do that on the same time frame or just drop one lower time frame and verify that the move up was built by several pushes. As you can see, that could be 2, 3 or 4, but basically what I want to see is few higher highs, few higher lows, and same on the correction. I want to see that this is done by basically a trend, not just one candle down, but it is happening as a movement. Okay, when I can verify that, I can basically go and trade it. And I want you to remember, avoid one-shot moves. When you see something like that, you cannot measure any Fibonacci retracement because the movement on the lower time frames from the top to the bottom would be one straight move. Not something that will really use or would be able to be helpful for your use, yes? So we want to avoid that. Now I would like to ask your help, and if you enjoy my video so far and if you enjoy my work in general, please hit the like button, leave some comment below in the comment section. Your help would basically help us grow and would be very much appreciated. So thank you very much for that, and of course, as always, I would like to invite you to my totally free Telegram channel where you can find education, videos, trading setups and ideas, and many more valuable things for traders. So to do so, just go to the description link below. Now I do want to give you the second thing here. After we define the ways we work with the Fibonacci's in terms of swings, highs and lows, we do want to do the next step. And the next step would be what candle patterns we can work with. I love to work with two main ones, engulfings and haramis, or inner candles. Okay, so remember this, and I'll show you that in a moment. And now, here we are, the strategy and the main trick of how to use that. So first of all, you define a swing high and swing low, right? And you want to make sure that there is a movement inside that. You can verify that on the current time frame just by observation, or to go to lower time frame and make sure you see that here, you see that there correctly, right? After that, here comes the trick. You want to see the retrace down, and what you are waiting for is to see engulfing or harami, inner candle. In this case, we got here engulfing, right here. Okay? If you have no idea what is an engulfing, I invite you to enjoy my totally free video about engulfings, and you will see that right on the corner, on the right corner of the video. You'll see the link to watch this video. So once we got the retrace, and the retrace would be okay if it happens to 38.2, to 50, to 61, even 76.4, there is no specific favorite level. I know many traders pay attention to 38, I know many traders to 76.4, I know many traders that love to work with 50 and so on. Specific level doesn't really matter. Market conditions change. Some moves go deeper, some less. That's all fine. That's why they are several levels to serve us. But here comes the trick. Don't just find the engulfing after the retrace or the harami. They, and listen carefully, they should come on a, I call it a stop loss area, and create some kind of a fake breakout. What do I mean? On the way up, as you can see, the move up was built by several pushes. We just saw that before. The last low inside the move up is here, right? Now, a lot of traders, those who normally rush into the trade, what they do is they start to buy here and here and here and here and here and here. Just believe that the move will start and happen because the trend was so massive. That's a very bad mistake to do so, to rush to do so. And moves tend to happen once the early traders give up. So there are many traders starting to do actions, but they lose once, they lose twice, they lose thrice. They say, leave it, right? Screw that. I don't want to use that. That's stupid strategy, right? And they leave it. They leave this, and then the move happens. After it catches all the stop losses, the move happens. So I want you to be able to identify that. So what you want to check is inside the movement you measure, which is this move up, right? Define the last low or few lows in the move up. So we have this one and we have this one, right? That's the two that we have. In that case, look what happens. The price crosses through this level, right? Through this level. There are a lot of stop losses located here, and then reverses up again, creating for you this beautiful engulfing. And since this moment, you got few most important conditions the traders need to verify. First of all, you verify the trend here, as it happens in few waves. You verify the good correction. You verify that the stop losses were taken on the way. You verify a fake breakout, attempt to break through this low and immediate retrace, and you got yourself a candle pattern. That tells you the buys are very likely ready to take off. So what you do next is, by the breakout of this engulfing, you get yourself a good buy conditions, and you would want to take your take profit around the top of the previous wave, at least, maybe even higher than that. So that's pretty much it. Very, very important is to respect a good risk reward. So if that's your risk, right, this would be your reward. You want to make sure, reward, and this is risk, right? You want to make sure that you have at least 1 to 2 risk reward ratio in your favor. Let's move on to the next example. Here we are again. We push upside in several levels, several highs and several lows going up. The correction happens also in 2 waves here. And now look what happens. We check on the previous move up. That was a very critical low. That was a very critical low. So we are looking for engulfings or inner candles, right? In that case, on this false breakout here, there is no engulfing, there are no inner candles. We don't want to use that. We are waiting for something good for us, right? And that's where we got the next level. This is harami. Inner candle, both body and spikes of the green candle are inside the red candle here. So what we want to do is, once again, once the high of this harami is broken, we would like to look for entries for a buy. This would be our protection level, slightly below the last low created, and our target would be at least on the top of the previous movement. And the risk reward ratio would have to be at least 1 to 2. The more, the better. The less, the worse. You don't want to have it less than 1 to 2. And here is the importance of risk reward ratio. Take a look what happens here. Move upside happens at this stage like that, right? Movement, movement, movement. Few highs, few lows going up. We use this level as a stop losses zone and this level as a stop losses zone. Now the first attack, stop losses zone, I mean basically the last low in the move up, right? Last 1 and 2 lows. That's what we mark, and that's where we are waiting for that. Now look what happens. A lot of stop losses will be located here and here. Now look what happens. The first entry was right here with this harami, with the breakout, right? This is our stop loss. We would like to take our profit here or even higher. Now look what happens. We start to move up. We got pretty good risk reward of 1, 2 already, but then the price retraces down and hit our stop loss. Could that happen? Of course. So we lost the trade. So what? Right after that, another opportunity by clearing this stop loss is making a fake breakout, and an engulfing comes in. So my next entry is with the break above the engulfing, my stop loss is here, and here comes the importance of the risk reward. I have all the reward up 3 times bigger than my risk. And I lost 1, but I profited 1 more, which is 3 times bigger, or at least 2 times bigger than my loss. And this is the importance of risk reward ratio. And the last thing I want to talk about is wait for your setup. One of the most terrible mistakes traders do is rushing into a trade. Oh, the Fibonacci retraced. Oh, there is a trend line. Oh, there is a resistance. Oh, there is always a reason. There is always a reason why to get in a trade. You do not want to find yourself forcing something that you would be able to regret pretty much fast. Why? Because if you rush into that before the market is ready, most likely you would find yourself in a losing position. If you will find yourself in a profitable position, it will be basically a luck, not something you want to rely on for a long-term journey, like trading. So you want to wait for your setup. You don't want to find yourself losing once, twice, thrice, and then say, oh, I give up, and then the move happens, but without you. So you don't want to find yourself in that situation. So what do? Is wait for your setup. Let me explain. We define this movement down. We can see that the push was done in several waves, right? Few highs are going down pretty beautifully. Now look what happens. On the move down, I mark myself several stop losses zones. That was my last one. This is the next one, and this is the next one, right? Several zones. These zones are using traders as stop losses areas. Now what we want to see is the market breaking above and going under this level again to create a fake breakout, as I explained before. Okay, now here look what happens, right? We did break above. We do have an inner candle here, harami, but we don't have a false breakout. We don't have this level going below this level again, and we don't have this level, right? So yes, we break above that, but no, we never go under. So a fake breakout never happened. So we are waiting for that to happen, right? And here both harami and the engulfing never created a fake breakout of the stop losses zones. Then after that, the prices continued higher, cleared this stop losses zone, right? Created an engulfing here, beautiful engulfing, and all the way down to the target. And you can see yourself what kind of beautiful risk reward you can get in such trade, at least 1 to 5. So this is very, very important things to pay attention to, and I hope that you could learn something new with my video. These tricks are tricks the traders do not pay attention to, and they do a lot of difference. So thank you once again very much for watching. If you enjoy my work and you enjoy my video, please show your support back, hit the like button, leave some feedback below. Your help is very much appreciated. And I would like to invite you to join me in my live trading rooms and enjoy our trading ideas day after day. To do so, just follow tradersacademyclub.com or follow the link to join us, possibly free, with our brokers program. The link to do so is in the description below. Thank you very much for watching. I'm Vladimir Rybakov, and I'll see you with other videos.